Want to achieve network marketing success? Then you're in the right company. Hello, and welcome to Leave Nothing to Chance, hosted by networking marketing giant John Solleder. Learn everything you need to know about the network marketing space from somebody who's actually done it. Join us every week for front row seats as we feature some of the finest and most successful personalities in network marketing. Leave nothing to chance. Join us now.
Well, hey, this is going to be a privilege, folks. This is a little bit different show today on Leaving Nothing to Chance because it's going to be really on finance, business, money, all things that we all need to probably be more cognizant of, especially dealing in the current economic situations that we're dealing with, not only here in the United States and Canada, but throughout the world. And we have listeners all over the place. So it's my privilege to welcome a new friend of mine, Mr. Sarry Ibrahim, to the show. And Sarry is well, amongst other things, he's the CEO and president of his own company, which he's going to tell you about a little bit today. He's also hosts his own podcast on money. And of course, my other computer decided, okay, here we go, to go down for a second. And that's called Thinking Like a Bank, which is a great title. So Sarry, welcome to the show, first of all. And how's the weather in Chicago today?
Hey, John, thank you so much for having me on. It's actually snowing, believe it or not. It's snowing here in Chicago.
Wow.
Almost April.
Yeah, crazy. Wow. Well, that's, what are you going to do? Yeah, sign of the times. We've got some crazy weather down here, too. We've got tornadoes and 80-degree weather followed by 30-degree weather. So figure that out. We're in the South. So. Anyway, so tell me a little bit, or tell our listeners a little bit about yourself.
Yeah, definitely. Yeah, thank you for that. So I'm from Chicago, Illinois, born and raised here, lived here my whole life. And I run a company called Financial Asset Protection. So it's a financial services firm. We help clients solve financial problems, reach their goals, get out of debt, pretty much whatever clients need, small business owners and real estate investors, we help them accommodate those things. And we work with clients in all 50 states, obviously over Zoom and over the phone. And we've been doing that since before COVID. So it's kind of like, it's pretty interesting how that happened and how a lot of work from home now is taking place. But yeah, that's what we do. And my journey really started kind of when I was like in high school. I took a class my senior year called Consumer Economics, and it was about very basic financial literacy, like how to write checks, what is interest on a mortgage, what are credit cards, how they could be terrible, how they could hurt you financially, and I really liked that class. I liked the concept of how we react to money, how we feel about money, how we react to it. So that was kind of imprinted at a young age in my mind to do something that had to do with solving financial problems. I got really into credit when I was younger. I wanted to boost my credit when I was like 18, as soon as I was able to get a credit card. This is before. So in 2008, they used to give credit cards to people who are 18. And then I think after Obama took office, he passed a law saying that they can't give credit cards anymore to people under the age of 21, because no surprise, there was a lot of credit card debt for like kids in high school. So I was in that. I was in that area. And I learned a lot about how money works, how banks works, and I wanted to make it into a career. I didn't really know how to do that. So I got my MBA with a concentration in project management. I thought I was going to be a project manager. I'm more on the business side, but I fell in love with sales and marketing, believe it or not. I worked at different insurance companies and I really enjoyed talking to people. Initially, I thought it was going to be a major challenge, but you never know, right? You never know until you actually do something. It might be the calling for you. And I love your show and what you're doing, because this is exactly what you do, right? Network marketing and believing in yourself and going really outside of your comfort zone. So that's what I did and founded the company Financial Asset Protection. We also have the show Thinking Like a Bank, where we show people how to think like a bank by applying the same strategies and principles. So I'm glad to be here, and I'm looking forward to talking about money.
Well, wow. There's so much there. And thank you for that, for the compliments as well. But let's talk about how to think like a bank. It's just a brilliant concept. I mean, when I first saw it, I was blown away by it. But talk about it. How do people think like a bank?
Yeah, so we're thinking, right, like if we're going to think of the most lucrative business, the most lucrative industry, it's for sure going to be banks. The banking industry in all of history and moving forward, it's always been the most lucrative industry. They have the most money, they control the most things in the world. And it's particularly the way that they operate, not just because of the fact that they're just banks, but what they're doing, right? So when I go to the bank, right, and I deposit, like, let's just say $1,000 into a checking account, I essentially am giving a loan to the bank. The bank now is in debt to me for $1,000, but then they take that money and then they loan it out to other people. They charge a much higher interest rate. Today, I don't think any checking accounts give any interest at all. Savings account is like 0.1%, but then they loan that money out. And it goes through mortgages and car notes and business loans and student loans. It funnels into the banking system. We don't really see that, and it's a thinking process that banks have, right? They're pretty much connecting people. They're connecting money from point A to point B and charging a fee for that. And over the years of doing research and like learning about different financial concepts, we've like discovered, like our team, we've discovered that it's not just banks that could do this. Really, anybody could, any individual, any small business owner could do this. And a lot of individuals and small business owners have been doing this for well over 100 years using financial concepts, like little known financial concepts, through different concepts of retaining capital, paying interest back to yourself. So that's kind of why we started the show, thinking like a bank. We're not just thinking like consumers or thinking like borrowers, but rather we're thinking, how do we make our money do more than one thing for us? How do we deploy it, make it work for us, and not just us work for money?
Right. And well, let's talk about debt for a minute,
Yeah.
because, so many people, and I'll give you a perfect example without naming a person, but long ago, in another lifetime, before I was married with a bunch of kids, I dated a girl who was pretty successful. She was an actress and did, fairly well. And I'll never forget her coming to me one day and showing me her credit card bill and telling me that she was making minimum payments on it. And it was even then it was 18%. This is about 30 years ago. It was 18% interest that she was paying on the outstanding amount. She was paying the minimum every month, and she made good money. And I explained to her, why she shouldn't do that. And that's a very simple financial concept that you understand and I understand, being money guys, being around money, interested in money, etc. But so many people don't have an interest in money. They make money and they don't understand how to pay debts accordingly. So talk about that a little bit. Like where did they start? If they have credit card debt, and they've got maybe a car loan, a home loan, miscellaneous different bills, where should they start to attack debt first?
Yeah, awesome question. So I think the first step is that you want to differentiate good debt from bad debt. So like I'll give you examples. So good debt is like a mortgage. And the reason why it's a good debt is because we're in a low interest environment. I think right now, like interest rates have just hit 4%, still relatively low compared to history. And mortgages are usually, you could do 15-year or 30-year. So if you did a 30-year, the monthly payments are going to be much less than a 15-year. And the interest is typically tax deductible. If you could, in the US, I don't know how the tax parts work in Canada, but in the US, if you could itemize the interest, property taxes are tax deductible. I'll talk to your tax advisor about that, but there's some tax advantages. And overall, you have like the control of owning your home. So I think that's an advantage of good debt. You're not locking up your capital within the home. You have that outstanding mortgage. I know a lot of successful, very financial, well-off people who intentionally have mortgages and they intentionally refinance and they spread out those mortgages. They do cash out refinances. It's almost, and they literally say they always want to have a mortgage for a reason. So that's an example of good debt. An example of bad debt, like as you mentioned, 18% credit card. That's a bad debt because the cost, number one, the cost of capital is really expensive. 18% it's a very high form of debt. A lot of that goes to interest and it compounds monthly, right? So whatever you have, your principal interest adds on to the next month. So it's a very dangerous, thing. Credit cards are very dangerous. They could be very dangerous for some people. And then there are no tax advantages, right, for the interest you pay in most situations. Unless it's a business and you're using the debt for business purposes, it's not going to be tax deductible. So really, credit cards have no advantages except for if you're using them for points and then you're paying off the balances every month. That's the only time I would do it. Now, let's just say you are in that situation, right? You have a lot of bad debt, like you have a lot of credit cards. How do you go about that? Well, back to that consumer economics class in senior year of high school, we had this quiz, and it was like this person has $10,000 in credit card debt. I forgot what it was. Let's just say 18% interest. And it was like option A. It was like, when will they pay off if they make the minimum payment of $25 a month, when will they pay off the debt? And it was like option A, 10 years, option B, 15 years, option C, 20 years, or option D, never. The answer is never. So if you had a credit card with like that high of interest and you were just making the minimum payments on it, you would never pay it off. So the way to escape that is you have to pay, depending on the credit card, the interest and other factors, probably 3 to 4 times the minimum payment to see some significant reduction. Because again, the principal interest roll into the next month and so on. They keep compounding. So you need to break that compounding by multiplying the minimum payment by 3 or 4 times. There's another method I use. It's called using a personal financial tracker. There's so many software out nowadays you could use, but I just make it very simple. And I take out like an Excel sheet and I write out the dates. Like for example, today's March 31st, 2022, Thursday. And then I write like how much I have in my checking, savings, cash value, life insurance, other positive assets. And on the far right, I write in how much debt I have. So let's just say credit card ending in 1234, and I have like $10,000. I see now all the credit cards I have and all the debt I have in general. I see it all in red. And then I make a plan, like which one needs to go first. If it's 0% interest until next year, or I have one that's a high interest, I might say, all right, let's get rid of this one. So there's a plan. There's a strategy behind what I'm doing. I'm not just guessing, like I'm not just writing bills and hoping that, everything goes away. There's strategy behind attacking that debt. There's like the snowball method where you pay off the smallest debt first, and then you take that money plus the money you're already putting into it, and then roll that into the next debt, and then so on until you pay off all your debt. So I think the takeaway is differentiate good debt from bad debt, and then have a solid plan in place to identify like, all right, credit card ending in 1234 needs to go by, December this year, or whatever the case is.
Great. So I love your response to this, right? There's an old saying that we came up with in the direct selling world that I've been in for almost 40 years. Take an interest in interest. That wealthy people take an interest in interest, and people who aren't wealthy, be they poor, middle class, whatever you want to term them as,
Yeah,
they don't pay attention to that. What you just said there, it's so right on. It's like if you had something at zero interest, well, don't worry about that. Let that one sit. Take the one, attack the one that you're paying this interest on, because the interest is what eats our lunch. So
yes.
love your response to that. Take an interest in interest.
Yeah. And Einstein said, interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it.
Brilliant. So let's talk about the best strategies in today's environment, right? We're living.
Yeah.
We don't have to tell our listeners. They know the times that they're living in, right? We've had COVID followed by a war that still isn't, as we speak here, it still isn't resolved. Hopefully, our show will air here in a couple of weeks, and by the time it does, let's hope it's done. It looks like they're at least talking to each other. But all that said, we've lived in some insane times, certainly the last few years.
Yes.
But having said that, people who have kept their wits are growing economically. What's some of the best ways that people can grow economically during these times?
Yeah, I think it's important to kind of like, what does that mean, right? To grow economically, right? To make more money, keep more money, right? To preserve more money. And how do we do that, right? We could do that a couple of ways. We could do that from our active income, like going out, selling, marketing, doing our actual things and earning active income. We have to be there, right? Physically, presently, we have to be there to make that money. And then there's passive. Passive is where other things make you money, like investing in a passive syndication, real estate syndication, right? Somebody else is doing the work. You are earning passive income, or investing in the stock market or mutual funds or bonds or brokerage accounts that could pay you back. So I guess like differentiating like active versus passive, and growing economically would be growing in both of those places, and with the intention of growing more of the passive side. So we're taking from the active and then moving that over to the passive. Now, why would we do that? Like why move active income into passive and then have the passive pay us back? And the short answer is so we don't have to keep working, right? So we don't have to keep doing the same thing over and over again. The thing that got me like really interested in sales and marketing was, you're selling, it's hard work, right? It's difficult, it's exhausting, but there's obviously why do we do it? It's because there's a return, a much greater return of doing it. There's a big ROI on it. But for me, what kept me in the field and what kept me going was the ROI of the residual parts of it, like making money afterwards without necessarily working. You still have to be there, but that's the passive aspect from the business or service. So I'm earning residual income from the product or service, right? But what about the residual income from things that don't involve your product or service at all, outside in different baskets, different areas? That's, I think, what people really need to focus on, is that you want to move active income into passive income and then earn that in the future over and over again. So that way, whatever happens in the stock market, whatever happens in the industry isn't going to be affected. And not all investments are going to have those places where you can invest in them, and then regardless of whatever happens in the market, you won't be affected. Only certain things can do that.
Great. great. And let's talk about the tax man.
Yeah, yeah.
Because the tax man cometh in the United States and he cometh in Canada. That's this time of year, for especially for people, a lot of them are people obviously are self-employed.
Yeah.
How do they save on taxes? What are some of the tax advantage vehicles that are out there today?
Yeah, so it depends if you are self-employed or a W-2 employee. I guess if you're self-employed, which I assume most of the listeners here are probably going to be self-employed. So there's
Probably 98%.
okay, good. So yeah, a lot of tax advantages, right? Pretty much from leaving your office or leaving your home to, using your cell phone. There's so many, talk to your advisor about that, but there's so many tax deductions there. But now at the end of the year, let's say you've exhausted all your deductions. Like, what do you do now, right? So I guess there's differentiating between using a pre-tax vehicle or a post-tax vehicle. So what that means is like, do I pay taxes today or do I defer that into the future? Like using an IRA in the US or a 401k. And I think in Canada, it's RSP, if I'm not mistaken.
RRSP.
Oh, okay. Yeah, yeah. So yeah, we're using a pre-tax. So we deduct our taxes today, put it into account, a qualified account. And then over time, let's just say 20, 30 years, 40 years later, we go to take that money out. All of it is taxable. So that's a strategy there, using pre-tax and then deferring into the future and then paying taxes in the future. And there's also another strategy where it's you pay tax on it today at your current tax rate, and then it grows tax-free and you take the money out tax-free. And both of those have their places for people at certain times and certain things. One of the things that we specialize in is the post-tax. So paying taxes today, after all the deductions, after everything, all the itemized things you've done, and then putting it into something that's post-tax and that can grow in the future tax-free and then comes out tax-free in the future. So yeah, essentially you can have a tax-free retirement. So back to going from active to passive income, you're taking active income, converting it into passive growth. So that way you can take out passive income tax-free in the future.
Great. And so let's talk about some specific products. And these are more US products. I don't know the Canadian equivalents. My wife is Canadian, so I do know the RRSPs because we obviously got some up there. But let's talk about thoughts on 529Cs, for example.
Yeah.
And describe them, if you will, because not all of our listeners will know. And they're either parents, they're either young guys like yourself listening that are having their families, or in some cases we have a lot of grandparents that might want to look at 529Cs or consider something like it. I don't know if there's another option or not. I'll ask you that question. In the marketplace for education.
Okay, so 529 plan could be that it's typically state specific, right? So it depends on the state you live in. Like I know in California they're not that advantaged, but to give some context, like a 529 plan is a college savings plan. Typically you can get a tax deduction for contributing to the money and it grows tax-free. And then you could take out the money tax-free with the gains if you use it for qualified expenses. So that's what a 529 plan is. And it depends on the state you live in. And it kind of goes back to like the control aspect of a qualified plan. This is where having like a financial advisor or more of a financial coach helps you, because it really depends on your situation, what your goals are, what tax rate you're in right now, what tax rate you'll expect it to be in. And I think that it goes into one of our concepts of having a financial coach, right? Having somebody who's like invested with you, who is alongside with you, working and helping you, achieve your financial goals. So a 529 plan could be good. It could also not be favorable, because what if you contributed to a 529 plan, you get into the tax deductions, but then your child doesn't want to go to college or they get a full ride scholarship. Then now all that money that comes out of the 529 plan is the gains are taxable. So just some small things to consider like that, and having somebody that works with you, who knows your specific situation and who can kind of be agile, right? And kind of go between different products and different solutions and methods, and kind of bundle it all together. So that way it's relevant to you. I think that's a really key takeaway from this episode.
Great. And let's talk about SEPs and other retirement type of plans, especially for people who are self-employed. And most of our listeners are either full-time network marketers or they're people who they do it on the side and they're trying to save for, in a lot of cases, retirement. Sometimes it's, something less large, a new car or, vacation or that type of thing. But, most of them are long-term thinkers, right? And we're trying to get them to think long-term so that they see their business as a vehicle to, do exactly what you're saying, put away money for their future, put away money for their kids' education, put away money that's deferred tax-wise. So let's talk about the SEPs for a minute and give descriptions, if you will, because a lot of our people, they're new to owning their own business,
Yeah.
maybe the last couple of years. So and they've been focused on building their downlines and their organizations, which they should be. And they haven't really thought about, okay, now I've got this extra money. What do I do with it?
Mhm.
So anyway, loved your conversation on that.
Yeah, and that's a good problem, right? Like you've gone through the hurdles of small business ownership, entrepreneurship. Now you have a surplus. You have extra money coming in every month. You have extra money in the bank account. These are fantastic problems we want. Like what to do now with that. And then yeah, exactly. You want to think about now moving this money somewhere that could outpace inflation at the least, that'll grow without you having to contribute any effort or skills towards that money or take on very little risk or some risk, but minimize the risk to grow that money over time. So this way, eventually, the passive growth of your money will outpace what you're earning actively. That's kind of like a goal you want to get to or consider at least. So you could do that, like you mentioned, SEP, right? SEP IRA. It's pretty much like an IRA for small business owners. And there's typically some nuances to it, like it has to there's come out of payroll or certain ways, but you can deduct your income that goes into it up to a certain limit. It grows tax deferred or tax free. And then when you take the money out in the future, you would pay taxes on it. And I think that it depends on, what you want to accomplish, right? If you're trying to lower your taxes this year, it would be a good idea. If you wanted to defer, if you wanted to pay taxes now this year, pay at your ordinary income tax and then grow it tax free, then you could probably look at a Roth IRA where you grow the money tax free, the money comes out tax free, and then you can even do self direct certain things like a Roth IRA self-directed into real estate or private money lending, or there's a lot of portals nowadays where you can invest passively in deals like through peer-to-peer lending and other things like that, and you can potentially use your Roth IRA to earn that. And because if you just, I mean, kind of on a side note, if you didn't do it with an IRA, that's fine. A lot of people still do it, but you would just be exposed to the passive taxes every year. So you would have your active income taxes from that plus the passive income taxes from that, which could be like a burden for you because it's ultimately you're going to pay more taxes that year. But if you have it sheltered into like a Roth IRA tax-free vehicle, then the money that goes into it isn't exposed to your taxes, nor does it affect your active income. Plus, and it goes back to the retirement thing. You don't want to earn a lot of money, a lot of taxable money in retirement because it's going to affect your Social Security income. It's going to affect, you're going to pay more taxes. It affects your Medicare premiums in retirement in the US. So like if you're over 65, you're earning Medicare, and you make more if you're married and if you file with more than $180,000 in adjusted gross income, it could expose you to IRMA. So that's income related modified adjustment amount. So that means you pay more for your Medicare Part B premiums because of your income. But what if your income in retirement was tax free? Then it wouldn't expose other areas like your Social Security tax, your income tax, your Medicare premiums. And that's what you want. You want to increase your retirement income without exposing any of those other things and opening up those doors.
One of the other things that comes up a lot, and my own mother passed away 2 years ago, but we were lucky. We had a long-term care policy for her. She broke her hip when she was 85, and she needed to go into a home. She passed at 92. And boy, that helped. And it didn't pay everything, honestly, but it paid. And I can talk about that a little bit because people are living longer. And it was funny. I was out doing my cardio the other morning. I started thinking how many friends I have, and I'll be 61 in May. How many friends I have around my age, a little older, a little younger, that still have either both parents or one parent still alive, where the parents in most cases are still in their own home, by the way. They're 85, they're 90, they're even in one case 95 years old. They're still living by themselves. So question for you on this, Sarry, is long-term care policies, are they or aren't they a good investment in your opinion? I hear both ways. Now, I don't want to be hypocritical. I bought one for myself. I bought one for my wife, okay, because of what happened with my mom. But I've heard the other side of it, that, maybe they're just too expensive and with insurance. I love your opinion. And also, if you can, before you get into the opinion side of it, educate people a little bit about what the benefits are, or what theoretically the benefits are.
Okay, so I'll start with what is long-term care insurance. So long-term care insurance pays for non-medical related things in nursing homes or potentially at home. So let's say, for example, somebody, it becomes, they diagnosed with dementia, right? They need care, right? They need 24-hour care. Not necessarily medical care, but physical care, right? They need to be taken care of. That's what long-term care insurance pays for, because In that event that somebody needs that kind of care, right? They go to a nursing home or they need home health care. There is no, your health insurance only covers like a small percentage. Like it might cover the doctor visits or the labs or the prescription drugs required. Medicare only covers the first 100 days of skilled nursing. So there's some limitations to what your health insurance and Medicare will cover in regards to long-term care. Health insurance does not cover the non-medical parts of long-term care, which is what long-term care essentially is. It's the non-medical part of it. So health insurance does not cover long-term care. So that means the only way that you can pay for long-term care is one of three ways, or a combination of three ways. So one way is cash, which in the US, as of today, the average nursing home cost is about $10,000 per month. And then number two, you could do a long-term care insurance policy, which covers some of those costs, but there could be limitations like co-pays, deductibles, things like that you have to meet. And the third, which is the most common and probably the least favorable, is Medicaid. Medicaid is a state and federal program for people who don't have enough money to pay for expenses, for long-term care expenses. A lot of people have middle-class lives, but when they become ill and they need long-term care, then they go to Medicaid. So it's not just people who have just been in poverty their whole lives. It's also everyday people. The majority of people end up on Medicaid in long-term care. So there's only three ways you could do it. The best way of those three is through a long-term care plan because it costs you the least in that moment. Plus, you don't have to give up. When you go on Medicaid, you have to essentially spend down your assets. So if you have $50,000 in a checking account and you want to go on Medicaid to pay for long-term care, you have to spend all that money on healthcare related items. So let's just say you went to a nursing home that was $10,000 a month. You would have to pay $10,000 a month for 5 months until you spend down your assets, or at least down to $2,000. And then you can be eligible for Medicaid. So you have to essentially get rid of all your money legally in a compliant manner, only on healthcare expenses. You can't gift any money to any family or friends within a 5-year look back period. So if you did gift somebody money, you have to wait 5 years in order to apply for Medicaid. So they trap you. In other words, either you pay cash or you spend all your money on healthcare until you're broke. Mm-hmm. That's kind of the Medicaid option. So the best route is having a long-term care plan. But now, in order to get a long-term care insurance plan, it's not that easy. It's not just something you buy in one day and then pay for it. And then when you need long-term care, you just use the whole policy. Typically, it tends to be really expensive, and they tend to have a max age at like age 55. So they're not going to insure people above age 55. At one point, over 100 insurance companies were selling long-term care insurance, but then it dropped down to like 5 companies because they couldn't take on that risk, nor could people keep paying those premiums. So it was a bad deal for customers and a bad deal for insurance companies. But a couple companies are still in business, and they're getting really good at giving like low-cost premiums. But then it opened up a whole new chapter in financial services, like long-term care hybrid products, where it's like not just a long-term care policy that you're paying a lot of money into and have to qualify for, but maybe an annuity with it or a life insurance policy too, mm-hmm. which is one of the main focuses of our firm. This is exactly what we do. We help do like hybrid solutions like this. So right. You could, in theory, get a whole life policy with a rider on there that allows for terminal illness care or chronic illness care. So that way, if you do need long-term care, it could pay for that. It has cash value in it that grows. It outpaces inflation. It's accessible, and it has life insurance, and and you could pay it up too. So that way you don't have any ongoing premiums anymore. And the growth of it is tax-free. If you use the money for long-term care, it's tax-free. If you pass away, the beneficiaries get the money income tax-free. So that's kind of, I think, what I would recommend for people to do, rather than just getting a standalone long-term care insurance policy. Get something that's more hybrid and that could do more than one function. So I know that was a lot, but that's kind of like what long-term. Yeah.
Well, but you're absolutely right, because when we first looked at it, with my mother, for example, a number of years ago, the riders weren't there. It was like, here's what you got, here's what you didn't get, here's what you paid for. Pretty black and white. Well, a lot of black and white with a lot of gray, as you know. Insurance companies' lawyers are magical about writing this stuff for them, not for the consumer, right? But by the time that we bought it a couple of years later, we got the insurance rider. So either one of us die. The life insurance basically pays back the premiums, et cetera, et cetera. Yeah. But to that point, folks, that's a good reason to get in touch with Sarry, or, if you already have a financial planner, somebody that understands this stuff. Because Sarry, I don't mind sharing this with you. My own dad, my dad was a working guy. He was a blue collar guy in New Jersey. He was a union electrician. And when it got to be pension time, as he got up in years, he had a guy on his job who told him that if you take the life only option on your annuity, you get more money while you're alive. Well, that was true.
Mhm.
Unfortunately, he annuitized his contract when he retired. He lived a whopping 9 months.
Oh,
And when
wow.
he died, the annuity died with him. And
Yes.
this is why, folks, it's so important to seek out people like Sarry or other people in the financial world. If you have a question, be it on long-term care, be it on SEP retirement, be it on 529Cs, be it on your life insurance, for that matter, be it on your property and casualty insurance, you have a question, you need to get the answers to this stuff, because you don't want to all of a sudden get sick and find out that you're not
Yeah.
covered because your name is Pete, and they only cover guys named Bob on Tuesdays, and you got sick on a Tuesday. And that's the way, unfortunately, the insurance companies are in business for the insurance companies, not for you. So
Yeah.
you got to make sure that what you get is what you're paying for. So without slandering any insurance companies, Sarry, because I know you got to deal with them, but just comment on that, how people should ask those questions of people like yourself to explain in layman's terms so that they have clarity on these
Yeah.
products that their hard-earned money pays for from their network marketing business or their traditional jobs or whatever, so that they have that clarity in their financial agreements.
Yeah, definitely. And really, like, I think like the simple way to answer that is when you're getting long-term care insurance or life insurance or an annuity or any kind of financial, something that's going to back you financially, it's going to back your family. It is never an over-the-counter product that you buy with the best rates or the best qualities to it. So it's not a commodity. It's not something that you're buying that appears to be the best. It's the person you're working with. That's what you're buying. You're buying the person you're working with, the advisor, their competency, their skills, their training, their problem solving abilities, and their care for you. That is what you are purchasing when you are going with these products and services. The insurance companies are just tools in the background. They're just in the background. They're at, we use them as tools. But really, and I see this sometimes with clients. So say like, all right, let's do this policy. What's the growth rate on it? And then work with another advisor and who's going to look at a different company. And I don't blame consumers for doing this, right? They want the best things, they want the best, but that's not how you find the best products and the best things. It's not an over-the-counter shelf that you're buying and you want to go to the best retail store that's selling it. It's about the individual, the person, the advisor you're working with. And if you trust them, they trust you, they'll find you the best things. They'll advocate on your behalf. Another thing too is that insurance, when you buy an insurance product or insurance policy, that's the first step. That's not the last step you have. That's starting the contract or starting it. There's what happens if there's a claim? What happens if rates go up? What happens if the company gets bought by another company? What happens if they decline you within 2 years because they find out something was incorrect on the application? It's always about the post application part with the insurance world that matters, not just getting it. So like really, really, really focus on the person. Take your time and deal with the person that you're working with, and not just the products or the companies they sell, because that's all really, it really means nothing at the end of the day. It really does. It's more about the person you're working with, holding the person accountable and liable for helping you choose these financial solutions.
That's great advice. So let me do my commercial quick, and I'm going to come back to you for one last question.
Sure.
Okay. So
Sure.
my name is John Solleder. So those of you new to the show, I wrote the book Leave Nothing to Chance, an Amazon bestseller, with my business partner Foster Owusu from beautiful Toronto, Canada. And prior to that, I wrote another best-selling book called Moving Up 2020 with another good friend of mine, Keith Hooper, out in California. And those books are on network marketing, but a lot of what Sarry and I talked about today, it's on money. It's on your future, because everything that we referenced so far on this show today is about your future, whether it's an event of kid or grandkid going to college. Okay, how are you going to pay for that? Your retirement, really, really important. And then the third subject that we talked about, right? Long-term care, because we're living longer. Maybe mom and dad are living longer. Okay, some of you are in that situation right now where mom or dad are in their 80s or 90s. You may be there. You probably will be there with modern healthcare. A lot of you are on great supplementation. You're taking good care of yourself. You're going to the gym. Probably going to live a long life. But who's going to pay for that? You don't want to run out of your money while you're still here, needless to say. And that's why financial prudence, financial education is so important. So, Sarry, let's come back. And I want you to tell people not only how to get a hold of you, if you don't have a financial plan, if you have somebody good, somebody you're comfortable with, that you've been working with, hey, by all means, stay with it. But if you don't, feel free to contact Sarry. He'll tell you how. And also
Yeah.
tell about your podcast and some of your other services.
Yeah, so we have the podcast. It's called Thinking Like a Bank, and you could find it at thinkinglikeabank.com. We release a weekly episode. We just released episode 54 today, actually. So if you want to learn more about raising capital or saving more money or saving on taxes or getting into real estate, either actively or passively, check out the show Thinking Like a Bank. I'm pretty active on LinkedIn. You can connect with me there. So if you go to thinkinglikeabank.com, everything will connect together. So the YouTube channel, the podcast, my LinkedIn, my email address, my calendar link to schedule a free appointment with me is all included. I also wrote a book called Thinking Like a Bank. It's more of an ebook that I give away for free. So you can go to the same website, thinkinglikeabank.com, and you can download the free ebook. Check it out. Learn more about the concepts we specialize in and how it can help you grow safe and predictable wealth over time, how you can grow money tax-free, how you can use it to support your network marketing business or other businesses you have. And I'd love to hear from you. If you're serious about changing the way you look at money and you want some financial advice, financial help, I'll be more than happy to help you out.
Well, Sarry, thanks so much, number one. And listen, I'd love for you to be a regular guest every couple of months here because, these are topics, folks. This is the topics you're not going to hear about at a network marketing meeting.
Yeah.
Okay. You know what I mean? Like we're talking about products and we're talking about pay plans and we're talking about a lot of other things that are pertinent to the here and now of getting started. But once you get started, you want that predictable outcome for the money you make during your working years. I can't believe, Sarah, you're still a young guy, but I can't believe I'm going to be 61 years old here in May. I look at it and I'm like, because I've been doing what I've been doing for forever. I started in college, as you know, but those years are going to go. What are you going to do during those years? If you listen to what Sarry shared today, great financial advice. Get rid of those high debts because they're robbing you. They're robbing you of your future. And they're robbing you from taking the money and putting it into passive investments that he mentioned or other types of things that are to your advantage long-term. Because remember, at the end of the day, and Sarry, I'm going to give you the last word on this, my friend, you are here to learn how to build a financial fortress around yourself and your family in the years to come. Sarry, I'd love your thoughts on that. And let's close out the show.
Yeah, thank you so much, John. Thanks for having me on. I really appreciate it. And like you said, it's all about the future, building up the wealth now. Interest is best built yesterday. The sooner the better. And then have time work in your favor. It was a pleasure being here, and I would love to come back in the next couple of months.
Great. Well, you're always welcome, and we're going to bring you back. So count on it.
Thank you.
Thank you for listening to this week's episode of Leave Nothing to Chance. If you want to know more about what it takes to succeed in the network marketing space, join us again next week for another amazing episode. For additional resources and to connect with John Solleder, visit leavingnothingtochance.com. Don't forget to leave a review, and we'll see you next time.